All right, welcome everyone. My name is Bronson Hill. I am the host tonight. My role is I work with Bronson Equity. We do multifamily apartment investing, as well as the three guests that will be here. We have right now we have Robert. We have a couple more that will be arriving momentarily. At least that is the goal. So you've had some technical issues to get started here, but really excited that you took some time to educate yourself. I'm going to give a brief intro to each person that will be joining us, and then we're just going to go ahead and jump right in. And Robert and I were just saying we've got a lot we can talk about, even if it's just him and I. So we've got plenty to talk about. We're going to go over some Q&A. We've just got a really exciting lineup here for each of you. So very excited to have you. Why don't you just drop in the chat there where you're coming in from, and go ahead and go for it there. So, okay. All right, great. So first of all, we have Vikram Raya will be joining us from Viking Capital. We've got Robert Ritzenthaler right on the screen here, who's with REM Capital. Welcome. And we've also got Bruce Fraser from Elkhorn Capital Partners, who's going to be joining us, having some issues with the technical side. Vikram, welcome. How are you?
I'm doing great. Can you hear me?
We can hear you fine. So we have we have Robert and we have Vikram. Bruce, I believe, is working on joining. So we're just going to go ahead and jump right in. I just gave you all a brief introduction, but the question really I think everyone's asking that is on here is really what is changed in multifamily investing over the past 1 to 2 years. We all know COVID has happened, but what are some ways that has affected multifamily investing? So why don't we start with Robert, and then we'll kind of work our way to Vikram, and if Bruce can join us, we'll get to Bruce as well. So go ahead, Robert.
Awesome. Well, good to be here, Bronson. Thanks for having me. Thanks for having us. Excited to chat a little bit, hopefully shed some words of wisdom in between a few jokes in the meantime. I was thinking about what's changed in the last couple of years. Not much. It's all the same.
Nothing's happened.
Nothing's happened. No, I mean, gosh, we've had a whole bunch of stuff. I'd say a little more than average over the last year or two. I just sent out a note to all our folks talking about how we're finally getting back to a good level of collections, and we're not having to kick people. Well, we did all the kicking out, and now it's kind of back to the people that want to actually pay rent. So that's been one heck of a journey over the last year and a half, dealing with the eviction moratorium alone. And then, of course, dealing with the rent relief money that didn't show up and trying to figure out how to get it. You know, it's always an interesting challenge when you're in the business of running a multifamily business where you can't collect your revenue, but your expenses continue unabated and increased. So I just say that's kind of like the number one challenge that I think we've had over the last year and a half. Certainly there's been others too, but that's been something that's changed. And I think we're getting back to a little bit more of a normal level, which is nice, but there are certainly some ongoing challenges that, we'll see what happens with the job market. I think everybody realizes that there's a very low participation rate today, which is interesting coming out of a quasi recession and going into whatever the next expansion may be. So obviously we can touch on that more later, but that's kind of some things that we've been thinking about, how that affects us going forward. So.
Absolutely. Yeah, there's definitely a lot of things that have changed on a lot of different levels. Vikram, welcome. And what about you? What are some changes that you have seen in the last 1 to 2 years in the mechanics of multifamily investing and your operations and what you're doing?
Yeah, thank you, Bronson. I agree with Bruce. I mean, I think he hit a dead on, right? Like, it's like nothing has changed and everything has changed. And to be honest with you, I'm actually being serious about that. Like, nothing has changed. Like, people are still buying a ton of deals. Like people are assuming that there was no COVID. It was like, all right, we're back to normal, right? In fact, it's like a frenzy. But then there was a period of time where there were 18 months, 12 months where it was like, there was actually a 4-month period where it was like all buying stopped. And it was like, where are we going? And it was like, is this the next precipice for, the Great Recession again? But it was completely a blip. And things just kept on, people corrected and kept on moving. And then despite the fact that there is, bad collections in some spots of the country, and there's some markets that are sluggish, there are other markets that are really accelerated. And I think the Californias of the world, the New Yorks, people are sort of migrating out of that, and the Sun Belt is really reaping the benefits. And so we're seeing robust progress in, let's say, the Atlantas, the Dallases, the North Floridas, the Phoenixes, the Austins of the world. What we did as a company is we actually grew our strongest, probably 6 quarters. Did we lose Bronson?
I hope not.
I think we lost our host, my friends, but we'll keep going, and I'm sure he'll join us back in. There he is. So in the last, we lost you, Bronson.
Welcome back.
Sorry about that. I was lost and I'm found, and I'm here. So I'm having some internet issues. I'm traveling on the go, but I think I'm back. So I'm sure what you shared was great, though. So I'm sure it was wonderful.
it was in fact, it was so powerful. I think we can end the discussion. No, I was actually getting to the
That's
point.
it. Mic drop.
We're getting to the point where I was telling them that, yes, this was like a cause for concern for a lot of people who are multifamily, but in a way, a lot of multifamily people probably made the most amount of money they've ever made during the last, 6 quarters, and it's incredible. So I'll tell you this: we own in suburban markets, and we own in like metro gateways, and we've done really well in the suburban markets just because of the COVID. People have realized that they can not be a chain to their work, and they can live in places where there's more amenities, more space. And then markets where it's more of and we'll have to bring some political context here, right? Blue states and red states. Red states, a little bit easier to operate in as a multifamily owner. The blue states, we own a mid-rise in downtown DC, 3 miles from the White House. It's been very difficult times for that project. We're still doing fine, but I mean, we're behind our pro formas, and the only reason for that is just because you cannot take these tenants out, and you try to provide programs for the tenants to succeed. They're not interested, and they know they're immune, and they're essentially untouchable. So, it's just things to think about as you decide. Hey, there's a lot of people on this call who are thinking about, hey, I'm ready to start to get into multifamily. I would suggest maybe thinking about what markets they want to start, operating out of. So,
Yeah, that's actually a really good point. Maybe we can kind of shift down that road. I know a lot of people, if they're new to this, are wondering, where do I invest in? And I know a lot of stuff we do a lot of red states, we do a lot of southern states because of population migration and other things. But how do you select a good market for investing in multifamily? Maybe we can start with Robert, and then we can kick it back over to you.
It's a good question. I do have to agree that generally the business environment has to be accommodating, at least. And I think that's something that most people would probably agree with. So that the politics has a lot to do with it, certainly. Not always, but I think it certainly has a lot to do with it. We've always kind of focused on areas where we felt like we had a more business-friendly environment, as I'm sure you guys have done the same. But I think from a location, what I've always felt is the most important is, go with an area that if you're working with the sponsor that they know really well. If it's something that is way outside of an area that or they know, it's going to be more challenging. So we've always tried to go in areas that we know well, or that we have a lot of boots on the ground, team members, people that have worked there, people that know the market, whatever it is. I think that's another really important factor for us, because at the end of the day, I mean, your team is what's going to make the deal work. So if you've got a great team that you can transplant from, let's say, Charlotte to Raleigh, and they can make the same thing happen in Raleigh, great, go for it. But that's been a big focus for us as we continue to grow, is making sure we have the team members that can grow with us. So I think that's important. But then, of course, you have to consider your different reasons for investing. And I think in general, you might get a little more yield if you're in, say, the Midwest, because you're going to get a little better cap rate. You might not get the upside that you're going to get in the Dallas or an Atlanta market, but you're going to have a little more yield. Flip side, you're going to get some nice appreciation in Atlanta. I mean, I think we're up, 20%, 30% in the last year in Atlanta. It's crazy. So there's certainly that upside, and you're paying a more aggressive price. So on the front end, you're going to get a little bit less yield. But, if you're willing to take a little bit of a higher risk profile to some degree, you'll probably come out okay. So I think that has a big factor. I generally tell, our folks that are more on the retirement level, if you will, to make sure they've got some of that sort of steady cash flow, lower risk, maybe not as exciting market like a Cincinnati or Columbus, to have that in their portfolio, because I think it's a good balance. But anyway, that's kind of how we look at it. I think there's sort of the deal side of it, but then also the team on the ground, the boots on the ground, and the execution part of it. So.
Absolutely. Just really a lot of different factors there. So it looks like we have Bruce as well. Welcome, Bruce. I know there were some technical issues. Excited to have you. How are you? It looks like you're muted there somehow. Maybe your button, there should be a mute button. We can unmute you.
Sorry, Bronson, trying to work off of my phone since the computer couldn't get through to your connection. Can you hear me now?
Yeah, I gotcha.
Okay.
Welcome. Yeah, it looks great. The quality is great. So it looks really good. So Bruce, we're just going over kind of what areas, how do people select certain markets of the country as far as a good place to invest? Do you want to tackle that one, or do you want to give a couple minutes and let Vikram go? And when you get set up, I don't want to rush you.
No, it's fine. Did you already do intros, or I missed your whole thing?
Yeah, we just did really brief intros. We just talked, briefly about how multifamily is changing, and we're just kind of getting into some different questions on what's changing within multifamily. And I think the part we're on now is just the how do people select like how do you select the markets that you invest in, and what are ways you maybe suggest investors do the same?
Sure. Well, first of all, Bruce Fraser, Elkhorn Capital Partners.
Oh, I think we lost him again.
Did we lose you there? I think we lost your sound there, Bruce.
Okay. Why don't I just jump in, and then we'll get back to him in a second.
Okay.
So back to the question. Yeah, I guess, how do you find deals in today's markets, and how do you find good markets, right? When we Viking Capital, we started in 2015. We were really an Atlanta-based operation, and because we really felt comfortable that we had boots on the ground, we had team members on there, and then as Bruce was mentioning, it's really important to have a powerful team members, and I would call them professional pillars, right? Your property management company is key, and whether you're fully vertically integrated, which is your own company, or a third party, it doesn't matter. You really need to have a powerful property management company, because that really is the way of your property management company is the way of the asset. And the second is, obviously broker relationships, really having those in this competitive market. It's everyone has the money. So how are you going to win the deals, right? So it's really that relationship building that's really important. And then it's where does your equity feel comfortable investing in, right? What parts, what geographies do they feel comfortable? What geographies can you hit the net returns? And he's absolutely right. The Midwest, we have a deal in Indiana. I mean, we got at a 5 cap. And, even in Indiana, it's hard to get. And we got a 5 cap for like a 2000 vintage deal, like a $76 million, 400 units. And, we were so lucky to get that deal, because, that same deal, people were ready to buy it from us. We only bought it a couple of months ago. But while, our Atlanta deals, they're so hard to get, or Dallas deals or Austin deals or Phoenix deals. So, it's sometimes you just have to play this geographic arbitrage, as well as, what markets are hot but approachable, versus they're hot but they're only hot to only a few select buyers that are within the the brokers like VIP list, if you will. So it also comes to a numbers game. I'll give you an example. We're projecting, we want to take down about 8 deals next year, and we're contemplating probably having to underwrite probably 1,800 to 2,000 deals to find 8 that work, that will actually win and take it to full completion. So, it's like you got to reverse engineer these kind of numbers to do this. And that's how you get to your end, So just some things to think about. And then, what's working for us to trying to find great deals in today's markets. I just want to give like 6 really powerful points. As I mentioned, broker relationships, expanding beyond just your core market. I would say loosening up your acquisition criteria. We love 80s, 90s, 2000s, but sometimes we flirt with 70s because even though we started our career in the 70s, we thought we graduated beyond that. But sometimes I'm not getting the quality of the deals I want in the higher vintage, and so maybe going, being reasonable with your criteria and loosening it up can sometimes help. And then we've formed really good relationships with sellers, and so sometimes going directly to the sellers, hey, look, we bought this from you. What else do you have? You know what? We can take it off your hands really quickly. We don't have to go through the whole, circus. And I know Bruce is like this, and I'm sure Robert's like this, but it's like putting aggressive terms, right? And say, hey, look, you want my firstborn? Sure, I'll give you that, and your hard money. Let's buy the deal. So.
Yeah, whatever it takes, right? And being creative with that. So, no, I think that's really good. I like that you said you mentioned something like 1,800 to 2,000, deals underwritten to get 8. And that's kind of sometimes the market that we're in, right? Is really having to do a lot of work, a lot of legwork to be able to get a deal done. Now, Bruce, I see you're back. Are you able to hear me?
I can hear you. I don't know.
Okay, we can hear you.
I'm on
so
brand new Apple technology all the way around, so I'm not sure what the struggle is. But anyway, yeah. So we certainly don't have the capacity to underwrite 1,800 to 2,000 deals a year. That would be 50 plus deals a day. I don't really think that that's feasible without a massive team. Luckily, we're looking at niches that we don't have to underwrite as many deals. Bronson, as you know, we typically buy distressed situation opportunities. We're buying foreclosure deals or pre-foreclosures, just poorly managed. A lot of people, probably the guys on the panel here, generally will be buying the nice, stabilized, pretty stuff that's already working, and they just figure out ways to improve profitability, make it better. We generally buy things that aren't working, but with our experience, know how to turn them around. And because of that, we generally are getting phone calls. Most of our deals come from an inbound phone call. We're not actually out bidding against everybody else offers. Like that's just, it's terrible because you don't really know unless you really trust a broker. And that's we work with a lot of brokers, but there aren't a whole bunch that I would, they are sales guys, right? And so you don't even know if there is anybody else at the table when you're doing a call for offers. You may be bidding against yourself, and that's the whole intent of that process. And so we like the niche that we're in. It's a lot more work in the first year or two. A lot more work. There's a lot of heavy lifting involved, but the returns have just been phenomenal. And right now we've got 3 deals under contract. We weren't really planning that. It just all came together at once. And so we're kind of scrambling to get everything done on 3 deals concurrently. And we've got more in the hopper that we just don't want to bite off more all at the same time. So, we're coming out of COVID. It was a very difficult environment for a lot of owners or a lot of new operators. Some of them had just assumed cap rate compression to drive the IRRs. And in some markets that's certainly happening, but when COVID disrupted some of the performance and affected their NOI, some of those forecasts became questionable and their partners started clamoring. And so, we would get phone calls of, hey, there's about to be a partnership disagreement here. Can you step in and take over? Or maybe they just lost the asset entirely and we would step in and take over. It's not always distressed to the point where it's in foreclosure, but we have one of the 3 that's under contract is literally at 95% occupied. It's just not being maximized on its operational ability. But that's rare to find those. It's usually where something's broken and needs to be fixed. We like that because if we buy something that's broken and fix anything, it's going to be worth more. Whereas if we buy something that's perfect, we have to make it even better. That's things have to really go right to make that work.
Right. No, that's really great. It's interesting how, and I think what you're going to see people that are, obviously watching is that everybody has a different approach. And I know what Bruce does, like you mentioned, will come in to put things that are really not working or there's some pretty major issues. and he'll be one of the only guys at the table, and that's a way to really become an insider in a lot of ways. Versus, I'm sure that happens as well with Vikram and with your group, the areas that you're in, and then also too, there's the just competing on more deals. So there's ways that you can find more deals through different sources and find ways to do it. Robert, what about you? What are some methods that you guys use to find deals? Maybe some ways that that's changed in the last couple of years.
I wish I could say we had a secret sauce, but unfortunately, I kind of feel like it's just good old-fashioned persistence. No, I think, actually it kind of goes back to what Vikram said, which is a really good term, this market arbitrage. I actually really like that term because it's kind of, to some degree, I've noticed, not intentionally, we will shift from one market to another depending on who's in the market or what's happening. And it's nothing that we're saying, we can see the future and we know there's going to be $1 billion of California money that's going to pour into Austin next month, so let's go over to Dallas. I mean, we don't know that, but it is kind of interesting how underwriting deals, there'll be times where I'm looking at a deal that's, one in Dallas, one in Charlotte, one in Atlanta, and I'm thinking, well, that's kind of weird because the one in Charlotte is 3.5 cap, and I can get one in Dallas for a 5 cap, so I'll go for the one in Dallas. And then other times it's a flip-flop. So it is kind of interesting from our perspective, being able to see those markets, and you just never know when that's going to happen. But seeing an opportunity, seeing where, hey, you know what, for whatever reason, there aren't as many bidders on that particular project. Hey, this one pencils. That's always a good day. So I think that's part of it. But I would say that in general, at the end of the day, your reputation is always the most important thing, I think. Regardless, I'm sure you guys would all agree with that. Your ability to close, your ability to deal with people, to do what you say you're going to do, just things like that really leave a lasting impression. Obviously, you have to be competitive. Nobody's going to give away their deal in a market like this, but as long as you're competitive and you can back up what you say you're going to do, I think that's really huge. And I want to say that out of the last probably 6, 7, 8 deals that we've done, 2 of them, we were actually backup offers. And I just wrote them off and I was like, yeah, well, you know what? We couldn't get the extra 2 or 3 or 5 million bucks, and that's life. Because we're pretty stubborn when it comes to our underwriting. And so, but sure enough, a month later we get the call and our broker says, well, all right, you're up. And, of course that's our opportunity to perform. And it's kind of a win-win for everybody. So I always come back to the reputation. It's really important, really powerful, developing and maintaining that relationship with your brokers and with sellers too, in a direct capacity as well. So, a
lot of people don't realize this about multifamily investing, but really you can get paid really well to solve problems, right? So if you can identify whatever the problem is, maybe it's a very unique type of problem. Maybe it's a seller has an issue with their loan, or there's some issue they want to be able to 1031, or maybe there's some issue with the operations. And if you can solve that problem, that's really how you get paid really well. Maybe we can start with Vikram. Can you maybe talk through maybe just a couple ways that you found some really unique problems to solve, multifamily problems to solve, and kind of either they helped you get the deal or it helped you to really perform well on the deal over time?
Yeah. Okay. Well, I have a more interesting story. It's probably our first deal that we did on our own. We were, initially when we started, like, I'm a car dealer, so what the heck do I know about multifamily, right? I was like trying to fake it till I make it. And, instead of stress testing patients, I was trying to stress test my assumptions on my underwriting. And so what I did was on our very first deal, I think Robert was mentioning, they were the backup offer, and it came to them. So there was a deal we had in Atlanta that we really wanted. It was 118 units. It was our first major project, and we lost the deal to a group from New York who was much more reputable and obviously had everything they needed to button it up. But then there was actually a murder on the property, and then they pulled out. They're like, this is too intense for us. Now we had an option, like literally, should we walk away from the deal? The deal pencils out beautifully. We're probably buying it for a really good cap rate, especially in Atlanta. And there's no serious trend of crime. This was like essentially a blip. We talked to the police department. We talked to the property management company. We actually did our own research. We traveled around that area. We sort of then had to check ourselves in the mirror and say, hey, do we want to do this? And so we rolled up our sleeves and said, this is probably a random act. We're going to clean it up when we take it over. And we did. And literally, it was one of the strongest deals we ever had. Like, we bought that deal and the deal next door for, I think, I think $8 million total. And we ended up selling the whole thing 2 years later for $13 million. And so it was a really nice pop for us. And it was all from that, hey, there's the surface level information and details, and then there's going maybe 3 to 5 levels deeper and really understanding an asset, understanding the demographics, understanding, the tenant profile. Is it possible to up level tenant profile and all of that, and sort of taking a little bit of a leap of faith, but also having trusting in your team, as we've talked about, and trusting in your business process.
Absolutely. Yeah. So being able to, just like you said, go layers deeper to understand what the issue is and be able to, have a team solution to that problem. So, hey, Bruce, we're talking about kind of some creative ways to solve problems in properties. And I know you've been really good at this, and you've dealt with some really hairy issues in properties. Can you share an example of a story or two of just ways that you've resolved a unique problem in a property, and how that's helped to benefit your investors?
Yeah, there are two questions there. I think originally you framed it as solving problems for investors, but I can talk about problem at properties as well. We do take over neglected situations oftentimes, and so it's kind of like being in school with a substitute teacher. None of the kids behave themselves. And so when the new strict teacher comes in, they have to learn that, hey, there's some rules here, and you have to act like a normal person. And so, we have some that are, have been fine. Takeovers are really smooth. And then we have some, I think, Bronson, about one of them that we did, and during the middle of COVID, and it was maybe 30% occupied. And if we're being generous, half of those we're paying, but there are probably more homeless people in the property than there were tenants that we're paying. And, it's honestly, you have to take the right measures. You have to manage with a stern fist. You have to get the right security. You have to make sure the place is lit up. We literally have a security company that'll run through the property with dogs in the first few weeks, making sure there aren't any drugs on the property and anything like that. Now that makes it sound like it's fairly extreme, but we're willing to take those steps to make sure the property is on track. I heard you mention also the murder on the property. It's sad to be in a position that we're in this business, but you learn pretty quickly that there are different kinds of murders, sadly. We bought a property that had a murder. We found out the same thing from the lender, but it was a domestic situation. Sadly, the person lost his job and was drinking heavily and was very distraught, shot his wife, and then shot himself. To a lender, that's okay, sadly. But, it's the drive-by or the drug shootings that are real. Aside from the loss of life, of course, is the real crime problem, so that it makes people hesitant about the property, as they should be. We don't want to have any kind of violent crime on the property. Certainly, anytime you have hundreds of people in one place, some things are going to happen, especially in the workforce housing world, which is where we focus. And they're just not the same socioeconomic level that some of the people on this call, on this panel, or listening to this may be, and so they just don't think through all their actions all the time, and you just have to make sure that they are held accountable. Now, as far as solving investor problems, that's I didn't get to do the intro, but I used to run a hedge fund for over a decade, and made a lot of money for investors doing that in the public markets, including through the financial crisis. And I personally had invested in real estate with one other partner up to that point, but we had sold everything in 2007 based on what we were anticipating happening. In retrospect, it was really well timed. But we started at Elkhorn in 2010 and have gone forward from there. And the biggest thing that we see is, and I know it's on your list, we'll dive into it later, Bronson, is inflation. We have a very data-based and strong opinion on the inflation outlook. And so I think, how we're helping investors is to position them to help protect them for what we anticipate is forthcoming.
That's great. Thank you, Bruce. I think that's a really good point. You know, we're a little different. Bronson Equity, we do talk a lot about other macroeconomic issues. We talk about real estate, but we also talk about them in light of monetary policy and all these other things that are kind of going on in the background. Because if you just ignore a lot of that stuff, you're not really paying attention to kind of what's actually happening in the world. 40% of all of the US dollars in circulation were created either digitally or physically in the last 18 months. But I'd love to go around, and we'll come back to you, Bruce, kind of toward the end, because I know you have a lot to say about that. But let's start with Robert. How would you see inflation, or kind of this new inflationary environment that we're coming into? How would you see multifamily investing being a good option or a great option, or like how does it fit in with kind of what's happening?
I think you got to sell everything and go cash. Just kidding.
Mic drop. He's out.
Right?
Yeah.
Hey, that
I'll
makes
take the other
sense,
side
right?
of that.
Yeah, exactly.
The world is ending. Sell everything. No, not quite.
Bronson, your viewership just went down to 0.
Yeah,
I know.
right.
I don't know what happened there. Well, we're making it. This is becoming like Jerry Springer. It's just becoming more controversial, and we're going to start beating each other up on the screen.
I'll pick up a chair and throw it.
I know, exactly.
No, I mean, I think that one of the reasons for me that's really exciting about the next few years is the fact that I do think we're going to have some inflationary challenges, but the best place to be is multifamily because it's a cash flowing inflation hedge. So I think we all probably do the same question. Okay, what happens if the economy flatlines? What happens if inflation goes crazy? What happens if this? What happens? Go through all these scenarios. And when I come out of every one of those scenarios, I say, okay, we're going to do better regardless of what happens. This is a great place to be. And I think it's kind of cool to be in that space because you can't say that about every other industry. I mean, if you have inflation, you can get hit really hard in other industries, where in our business, if you know how to run your operations correctly and your revenue keeps clipping along, even if the cap rates, the valuations don't go the right way, you're still going to do fine. So I think that's really key. I do think there's going to be inflation, probably, although I still look at Europe and I look at a little bit of Japan and what's happening there with their interest rate environment, and it makes you wonder. But I think we've got enough growth, probably, that we won't see that same scenario. But you never know. I mean, the Fed has a lot of power, so they can move things around, and we'll see what happens. But that's kind of our perspective, is that it doesn't really matter to some degree what happens, because I think multifamily is going to be that solid investment regardless of whether inflation goes up, whether it goes down, whether the interest rates go up, they go down. Now, obviously, that being said, I think as a good operator, you're going to make sure you're hedged so that you're not completely out there hanging in the wind. And of course, we could get into all the nuances of that. But I think in general, if you are conservative in your structure and your financial structure, I think you're going to be protected. And I think this is one of the best places to be, personally. And I know, people say, "Oh, you're biased. You're in the business," but I really believe that. So,
Vikram, what about you? What are your thoughts?
Yeah, I want to stack on what Robert's saying. With inflation, what do we see? Right, we're going to see increase in labor, material costs. And then people who are trying to build right now, developers are eventually their price points are going to get higher. So there may be less development going on, even though there's a ton going on right now. But as cost and labor, go up, that's going to make their basis go higher. So that's going to make the existing properties obviously do well. And then overall, as overall prices go higher, then real estate, all the existing real estate that you already own will definitely rise in value. And then think about it this way: we're going to be able to raise rents, but hopefully we've gotten pretty good interest rates. We've gotten fixed interest rates on these properties, or relatively stable. There's a cap on them, or if you even have a floating rate, there's a cap. So rates are going up. Our debt's relatively fixed, and so that's just again creating more NOI, which is again further increasing the value. So all of that sort of explains why multifamily again is a very powerful vehicle as inflation buster. And it's a really good place to park your money in your cash. And again, not only is it the tax breaks, the cost, the bonus depreciation that you get, plus the cash flow, plus the tax efficiencies on the tail end if you want to 1031, but now you're getting all the inflationary benefits as well. So that's like a fourth major benefit that people don't even think about. So,
right, it's great. It actually pays you to hold it, and there's an inflation hedge there as well. All right, Bruce, let's bring us home. Tell us more about monetary policy, inflation, and anything we missed here. I'm sure there's some stuff that we missed on.
Well, I have some thoughts on this because we've had those conversations face to face, and I think we're pretty well aligned. But I'll start by saying I was on a panel about 3 years ago at IMN, and every single participant at that conference was saying how real estate was late stage, it was extended, late stage. You couldn't find anybody that would take the other side. And it's been my experience as a professional investor for decades now that anytime everybody believes that one thing is true, it absolutely isn't true. And, over those last few years, I've literally made millions and millions of dollars for our partners. And that's not just a momentum play, though. It is fundamental based on the data. And, it's not, I think it was Robert that just said this, but, I'm not talking my book. I'm not saying, hey, I'm saying that multifamily is a good place to be because that's what I do. Well, yeah, it is what I do, but having been a hedge fund manager for so long, I'm pretty good at making money in the markets as well. And this is where I spend all of my time now. And so it's a decision, it's an allocation decision based on the strategic outlook that we have. And to be clear, it's not even a question in my mind. It's, the U.S. government debt is now $28.5 trillion, which is an enormous sum. And you get lost in whether that's a B or a T, and it's bigger numbers than most of us think about usually. But $28 trillion, that's their debt. That's before the $6 trillion of infrastructure spending they're planning on. And frankly, that's only the stuff that they've explicitly borrowed on. They have all these things called unfunded liabilities, which, by the way, include Social Security and Medicare. If you add that in, which if it was you or I or any other business, you would have to add it in as a liability, that totals $130 trillion. To put that in perspective, the U.S. government only collects $3.5 trillion a year all in, yet they're spending over $7 trillion every year. So it's not like they're paying down the debt. And so when you graph this, I recently wrote a piece on inflation actually, and but we put the graph of the U.S. debt on the page, and it literally bottom of the page to the top of the page, it took that whole scale to show the radical increase in the debt levels that's been going on post 71. And so, how does that translate? Don't want to go too deep here, but I don't think inflation isn't even something to discuss. It's pervasive. If you look at the U.S. dollar's purchasing power, any 10-year period in history, it's lost about 20% of its value, at least over any 10-year period. If you look at the most recent couple of years, it's been much more rapid than that. I mean, inflation is not an outcropping; it's a planned necessity. The U.S. government simply cannot pay this debt back. They don't have the means, they don't have the income, and that if they were a business, it would be insolvent, but they can print modern money. And so the game is to have a ton of inflation, but not show it on CPI. And so it's a policy decision. It's not an accident that this is going on. They have to have this in order to pay back the debt. And so I think the best way to protect yourself without getting too dark here is just is hard assets. And that could be timber property, it could be oil and gas mineral rights, it could be gold, it could be silver, land, multifamily. I'm preferential to multifamily. I think of all the different asset classes that you feel like could be strong protection against rapid inflation, multifamily is really one of the safest. And we've seen what COVID's thrown at it with the lockdown of the last year, and it's still making money. And so, I mean, think about that. That's a radical kind of 3 standard deviation event that occurred to the entire industry, and there's still money to be made. So that tells you it's really hard to disrupt. It's something that, with the inflation as that continues, your middle class and lower class income individuals, they're going to be renters for life. People that are selling right now their homes so that they can, lease for a couple of years until prices come back down and they'll buy back in. If they sell their homes right now, they're going to be out. They're not going to be able to buy back in. And so I would discourage anybody watching this from doing that, by the way. So I mean, that's kind of our view. It's not terribly optimistic, but you have to know the game that's being played on the field so you can field the right team. And that's what's happening. It's really clear. And so we're positioning accordingly. Oh, one last thing to tie off. If you look at studies that have been done on, how do you position, just unbiased, not talking to just Bronson or me or the rest of the panel and the multifamily guys, what has done the best over the long run in inflationary periods is commercial real estate, number one by far. And, we've got the studies to back it up. It's not our study. It's, JP Morgan Guide to Markets. You can get it out of that. Get it from your broker. That's what it says.
Awesome. Thank you, Bruce. I really appreciate that. It's a very comprehensive response. Appreciate that. We're going to take some questions here in a minute. So if you have questions, go ahead and drop them in the chat, or waiting for you guys to put some questions in there. I do have another question for our panel.
Bronson, can I follow up? What
please,
about
sure.
Bitcoin and crypto? Where does that fall into this?
Should we talk about Bitcoin and crypto? Yes, you want to ask Bruce. Okay.
Do we really want to dive off the deep end?
I think, we, in the piece that we put together, it has quotes from a lot of famous investors, Druckenmiller, Paul Tudor Jones, all these people that have been phenomenal over multiple cycles. And I don't want to go on a tangent about crypto. I know that Bronson's had some educational events on that as well. But I will say, Paul Tudor Jones, he's the guy that called the crash of '87. He's a billionaire, self-made, made a fortune. He was on CNBC last week. They asked him the same question because he was saying real estate, you've got to be in hard assets. And they asked him about crypto. And he said he personally holds low single digits of his own net worth in crypto, but that's not a big bet for him. He's not planning to go big on it. It's too speculative. It's an alternative currency to fiat currencies that I think a lot of people would prefer. So people can't just print more of it, people being the central banks. But the central banks are going to fight it tooth and nail, because if they lose control of the currency, then they lose all of their power, and they're just not going to let that happen.
Yeah, central banks like to stay in control. That's for sure. No, it's good. And there's a lot more conversation around this too. We do have we kind of go back and forth. 1 month we'll have events on multifamily, and then the next month we'll have an event on inflation. So we have one coming up November 17th about inflation that I'll kind of announce a little bit more about, which would be great to have Bruce back on one of those as well, because that's kind of overlap of both. So
happy to do it.
Yeah, so we're gonna again go ahead and drop your questions in the chat box there. We're gonna take those in just a minute. I wanted to go Robert, Vikram, and then to Bruce. What are some mistakes that you see maybe newer investors or people that invest passively into multifamily? What are some mistakes that you see people make when it comes to investing? Let's start with Robert here.
Yeah, well, I would say the number one mistake that I've seen, having talked to thousands of people, which I'm sure you guys have as well, but the number one mistake that I've seen is, generally speaking, the folks with lower net worth, number one questions, I should say, major focus is all about the deal. Every time. How much am I going to make? How much am I going to make? How much am I going to make? And it's kind of interesting how you go up that scale, and the questions about the deal get fewer and fewer, and the questions about the sponsor become greater and greater. And it would always fascinated me, the people that have the most amount of money are much more focused on the questions about the sponsor. Now, I think there's a couple of logical reasons for that. People without the money want to make a bunch of money, and the people with the money just want to protect it. So when you're thinking about protecting your money, you have a different strategy than I need to triple my money in 2 years type of thing. But I think it is something to consider as an investor, to really ask yourself, what kind of money am I investing here? Is this crypto money to have fun with, or is this my retirement money? And if it's your retirement money, I think it's really important to get to know your sponsor, get to know their experience, get to know what markets they're in, how long they've been there, what they've done, all that kind of thing. And it's not as exciting, and it takes more work, I think. But that's probably the biggest mistake that I've seen, is people that'll chase the returns, they'll get burned, and then, usually they learn and they come back. But it can be a painful mistake. So if I was going to narrow it down, I would say that's probably the number one that I've seen over the years.
That's a great point. Focusing on the deal more than the sponsoring group. I think that's a really good one. Vikram, what about you? What's a common mistake you see investors make?
So I'll use the broader word of investors as meaning even like real estate investors that these, passive investors are investing in, like the GPs or the sponsors, right? So some of the sponsors, like you want to see, like who are they in bed with? Who are the partnerships? Like it seems like it's one person doing the deal, but then when you peel back the layers of the onion, oh man, there's 5 other people on this deal. Like who are they? Like what's the voting percentages? Like who controls the deal? What I realized is 1, 2, and many. So if you have 2 people on the deal, fair enough. But once you get 3 or more, it's starting to get very convoluted, and it's like a 3-headed dog, right? No one has right of way. And I've been part of a, I guess as part of a learning curve, I've had relationships with where we've done a deal with in our early stages where we had 3 people, 3 sponsor groups, and I felt it to be sort of slowing us down, and so that's something to be very wary of. I would definitely stick to where it's just 1 sponsor, maybe at most 2. Number 2 would be to really check the underwriting, and the limited partners may not understand a lot of that, but it's really to ask, sort of have a come to Jesus moment and really ask them some tougher questions about the underwriting. Like, hey, are you assuming 5% rent growth for all 5 years, or is it just for the first year while you're doing the value add? Also, ask the sponsor some tough questions like, hey, have you ever missed a distribution? And it's not a game. It's not like a game over if they said no, I have missed a distribution. It's more like, hey, what did you do to handle that, or how did you handle a bad deal? Like, because everyone, if you've been in the game long enough, you've had a deal go sideways, right? So ask the tough questions. Like, did you guys, do the partners put in their own money to stabilize the property, and then we didn't have to do a capital call to the investors? Questions like that. Find out about the relationship between the group and the property management company. Like how many deals have you done with that property management company? If you've done 3 or 4 of them, then we know it's probably going to be smooth sailing. Is this the first time you're working with this property management company? That's a little tenuous. And the other thing is, do they have enough capital to sort of complete the deal? A lot of times deals sort of fall apart or don't do as well because they get undercapitalized. So making sure there's enough capital to do the value add, to handle any surprises for any economic market, sub-market fluctuations, and just ride it out to the exit plan, which is usually 3 to 5 years.
That's great. No, that's some great examples. Bruce, what about you? What are some things that you've seen mistakes investors make?
Yeah, I mean, I agree with Robert and Vikram both. They both brought up a couple good points. I'll underscore the ones that I think are super important. I mean, number one, and Robert talked about this earlier as well, was you have to know and trust your sponsor, because at the end of the day, they're either going to make it happen or they're not. Example, one of the guys on our team, we were leaving my house 6 a.m. one morning to go drive up to a market and look at some property. I saw a good friend of mine that's an investor in most of our deals. He lives in my neighborhood, and rolled down the window and he said, "What are you guys doing? Are you headed, to that market?" And I said, "Yeah." And he said, "Well, I'm in for 200. I mean, he doesn't know the name of the property. He doesn't know anything about the return. He just knows he trusts me. He's been in another dozen deals with me. I've always made him money. It's all he cares about. And you don't want to be aloof about it. But once you find a sponsor that you trust and has delivered over and over for you, the deal becomes much less important. And I agree. Some people will kind of hone in on what's the average annual return they're positioning. What are they? This one says 19, that one says 18, so I'm going to pick the 19. Well, what's more important is, have they actually done it before? Have they delivered what they've said? And how are they driving it? I think that was Vikram's point. If you look at a deal and the entire return is being driven by cap rate compression, well, that may happen. And based on my macroeconomic view of inflation, I think cap rates could go lower. But you don't want to only be able to make money by finding the next greater fool, right? I mean, you would like to be able to make money just by holding it, not even by having to sell. And so those are critical pieces. I mean, I think there is a lot of uncertainty in the market when you're talking to sponsors or potential sponsors with investors. And I would encourage investors to quiz the sponsors just like a lender would. Who has the capital? Because in these deals, somebody has to show substantial amount of capital that has already been earned and is already on the balance sheet, not by the property, but by the people involved individually. And so there's this whole practice of renting someone's balance sheet, where someone will allow, will receive payment for them using their balance sheet. Well, at the end of the day, if something goes wrong, they don't really care. They're not going to be involved. And so it's not really, to me, as solid as, if someone wants to see a proof of funds or balance sheet from us, we're happy to share it. We have the money ourselves. We don't need to go find somebody that has a sheet of paper to show you. And, I would also encourage you, 2 other points, and then I'll be quiet, Bronson. I know I ramble. One is, real experience. What are your full turns? Where did you set expectations? Where did they end up? We have a sheet that has all the deals we've ever bought, where the EGI was when we bought it, where it was where we operate it now, where occupancy was when we bought it, where it is now, where the value was when we bought it, where it is now. And we share that with prospective partners and lenders as far as that goes. And then the other thing is, Vikram mentioned this, is the practice of multiple partners or multiple general partners coming together to do a deal. I would be really careful of that. I know it's needed for people that are newer in the industry or that are taking on huge new deals. But if you see, I agree with Vikram, if you see more than 2 people on a deal, then nobody's really doing anything. They're all kind of just bringing a little piece to the deal. I mean, I've seen deals where people are in Vermont and Hawaii and, who's going to be there actually dealing with the property? Who's going to walk the property and check on it every few weeks? Who's going to deal with the property management company? Not the guy from Hawaii, And so, I mean, really poke at that and see who's getting the call or who's, I hate getting a text with just a link from my property management director. First thing in the morning, that means either something's on fire or somebody got shot. And so, it's never good, but, somebody has to deal with that. And it's, you want to know who that is and who's making those day-to-day decisions.
I think that's good. That's a lot of good stuff, Bruce. I think I learned that next time I have to raise some money, I need to get in a pickup truck and drive around with you, and somebody will throw $200,000 into the back of the car just because it's that easy, right? It's just we'll throw the money when it's time. But no, if you have good results, obviously people want to be a part of it. So that's wonderful. We have got a few questions here. I want to see if we can get through a few of these. Feel free to drop your questions in there.
Hey, Bronson, if I may, I've been just mesmerized by the graph behind Bruce, and I'm wondering, can you give us the stock tip, man? I just see an upward slant right there. I'm like, oh, maybe I need to get that.
We'll do that offline.
On this call, he's already made $100,000.
All
right. He's multitasking.
I mean, last thing you want to do is look at my own account, because I'm kind of like the cobbler's kids. I'll be off doing 4 or 5 multifamily deals and I forget what position I have on. So we do have some quant strategies that work great, but that's a different discussion.
I love it. He's a student of many disciplines. So, okay, so we've got a few questions here. Chris is asking, do any of us invest in the LA market? The answer is no, unless any of you buy in Los Angeles. Nobody else buys in Los Angeles. I invest only outside of California for many reasons, kind of that were mentioned as far as areas that are good to buy in. So really, if you live where you want, invest where the numbers make sense, I think is something that's really good to do. There's a question from Douglas. Do you advise diversifying your investments into 2 to 3 operators, or to go with a single operator? What would you recommend as far as people that are getting started in multifamily investing? Whoever's ready or has some thoughts.
I mean, I'll jump in there if nobody else has an opinion. I think until you know somebody, I would test a couple. I think spreading it around is kind of like peanut butter. It's kind of like in the stock market. If you over diversify, you're never going to have any good returns. It's just going to be very mediocre. And so if you find a sponsor or operator that you really like that gets good results, just go again with them. Just don't go big on any one deal. Spread it out, diversify by being across multiple deals. I mean, coming from the stock market background that I did, my initial thought was, we'll buy one asset here, one asset there, all different markets, kind of be diversified. That is, at least based on our experience, that is not the right model, because then you're chasing all around the world, trying to check on properties. You don't have any leverage with the brokers. You don't have any leverage with the vendors. And so we really concentrate in certain markets. And, our goal is to be 2,000 to 3,000 doors in about 5 different markets. And we already have that in one market. We're well on our way in another market. And what that brings is that, if a broker in one of those markets calls me, I don't need to see the name on my phone. I know their voice. I know who they are. I know, who their kids are and what's going on with them. And they know what deals I want. And so they only call me when it's important. And also on the vendors, when there's an ice storm, which we had in one of our markets, and it was just devastating to the area. Who was there 8 a.m. on our property? The contractors were on our property at 8 a.m. Cleaning out the offices so the managers could get in there. And that goes a long way. And you need to get something done. And prices have changed, like right now due to inflation, and they make good on the prices they quoted you a couple months ago because you've done so much business with them. There's a lot of power in that.
Yeah.
I like to stack on that a little bit. Like one way to sort of kill two birds with one stone is maybe you don't want too many sponsors because you're tired of like getting 15K ones in your mailboxes, right? You just want one or two at most. The other way is consider working with a sponsor who has a fund, and they automatically diversify. They diversify across. Depends on the fund, right? It could be multiple asset classes, or if it's a single asset class fund, they may have properties in Dallas, Austin, Atlanta, Florida. So then you're getting a little bit of a sort of a blended return, but you get some diversity, but still it's the same operator. So I would say, test drive at the beginning, flirt with a couple of women, but then, hopefully end up marrying one of them or two of them at most. So.
Marry two, have a little bit of drama at home.
Only in, I don't know, is that allowed anywhere?
Utah. I don't know. It depends on what country you're at, I guess.
Yeah, right. Exactly.
Yeah. Marry may have been the wrong word.
Yeah. Or commit. I mean, something.
Commit, yeah. Robert.
No, I think it's a good. I would agree with the other guys. I think it's a good idea to have 2 or 3. You don't want to go 5, 6, 7. I think that's just too much. But I think it's important, and I think partly it helps you as an investor figure out what you want out of this whole relationship too. And I think that, again, that goes back to know your sponsor, get to know them, because certain personalities are going to connect better and certain deals are going to connect better with what you're looking for. And you may appreciate one particular operator's style, how they handle things, how they underwrite, their risk profile better than somebody else. And you may not know that if you just, you do one and then you stop there. So I think it's, again, obviously time is a factor because it takes time to get to know different sponsors. But I would say, 2 or 3, get to know them, maybe always ask for referrals, but I think that's a good way to go. And I think you probably will narrow it down. Like Vikram was saying, you probably will narrow it down to maybe 1 or 2. I think most of our folks are, I would say 2, maybe 3. I mean, there's a decent number that have just decided, hey, we're just going to stick with REM, and that's fine too. But I think there's a lot of them that, they've got a couple in there that they appreciate, they connect with. And I think that's important too, because I mean, at the end of the day, like I said, I think it's a relationship. There's a lot of good operators out there. And if you connect with somebody and you feel like you understand how they work, I think that's really important because you got to be able to sleep at night and you got to be able to trust the person that has your money. Like Bruce said, somebody that can trust you and says, hey, I'm in, count me in, whatever. That's really important. You want to get to that point, I think. As an investor, you want to get to that point.
Yeah, the other thing about having more than one sponsor that you're working with is, one sponsor, they're looking or hopefully looking for a specific type of investment as opposed to every investment that comes to them. And generally, that means there are going to be periods of time when there's not an investment available. And so you may have capital that you need to allocate and want to get it out of cash because of inflation or something else, and there's not a deal available. Well, it's good to have more than one person you're talking to. Now, again, but I would also ask not just investors, ask other professionals in the industry. We have a mortgage broker that invests with us. We have our real estate attorney invest with us. Our insurance guy, a broker in our market told us we're the best operator he's ever seen, and he invests with us. Ask the professionals in the industry who they think is good, and they know. The brokers know absolutely who's doing a good job and who's not, because they see it and they see who's needing to sell because things aren't going well. And they see who's accumulating, So I think it's good to spend your time early, take your time, because once your money's in the deal, it's in a private, not very liquid investment, and it's going to take some time to get it back. So be cautious about it, but just keep in mind that the money's melting while you're holding it. So
exactly, yeah. Let's talk about inflation. So we're going to just be sensitive to everybody's time. I did want to. There's one question here I wanted to just touch on, and then I'm going to have everybody give their contact information. But not everybody needs to address this. If somebody had a sentence that they wanted to say, or a couple sentences, do you see a major impact of the current administration forces IRAs to close in a couple of years, or it does not allow for real estate investment within IRAs? Does anybody have a thought on that?
It was about 10% of our deal capital when we first got started. Now it's probably less than about 3 to 5%. I still think it's a travesty if that does happen, because that's a great way for people, especially early and new investors into the multifamily or alternative investment space, to get money that's not doing anything that's in like a mutual fund or some low income producing asset, to actually convert it into something that's actually going to generate significant wealth and gain traction. So I hope they don't turn that around. And we've made movements to where we've had people in our own investor basis write letters to the congressman and things like that. But yeah, I think it's a valuable tool for the common investor to invest in alternative asset classes.
Sure.
Yeah, I'll just add on that. I don't think it's going to change our industry much, but I do think because I think people will move their money and they'll figure out how to invest it. That there's, if you want to invest, you'll figure out how to get it in there. But the part that concerns me is the reasoning behind it. And again, I know that's not what we're here to talk about per se, but that's the part that concerns me, because I think it's moving away from a model that says, hey, you should be able to invest wherever you want to put that money in, obviously within reason, but we're not saying go out there and throw it away. But that's the part that's more concerning to me, because I think it's locking things down versus opening them back up. And generally speaking, when you have more open competition, I think we probably all agree everybody benefits at the end of the day, unless it's a monopoly situation. But that's kind of the problem that I'm seeing, is that if you take this opportunity away, there's trillions of dollars that I think would love to get into the multifamily space, and you shut this down, I think you're kind of limiting that. And again, we need capital in the multifamily space to continue to provide housing for the country. And there's a drastic shortage. So how are we going to do that? By pulling the capital out? I don't think so. So that's part of my concern from a macroeconomic perspective. But sorry, Bruce, go ahead.
No, I was just going to agree with both of you. I think like Vikram said, I think it would be a travesty, because I think, a more open economy is the right way to go. Let people have their choices. It seems contrary to the grandstanding that a lot of politicians do about the big banks and Wall Street, to make an environment where people can only invest with those people, right? That doesn't make sense. But I don't think it'll probably pass, but who knows in this environment. I will say though, if you have a choice between tax deferred money and regular taxable money, the right choice from an investment advice perspective is to use your taxable money to put it in real estate, because it works actually better than an IRA wrapper would anyway, because not only do you get tax deferral, but generally you're getting losses on a K1 basis, on an accounting basis, that you can write off because of depreciation and other matters. Now, the problem is a lot of America, most of their money is in retirement savings. And so, but depending on the return outlook you expect from the market versus what you might get on the right kind of real estate investment, honestly, it may make sense even to pay a penalty. But yeah, I hope it doesn't happen. I think it's the wrong thing to do. But if it does happen, I don't think it's going to be the end of the world for the industry. I just think that the right decision is to use taxable money anyway.
All right. Well, gentlemen, I really appreciate each of your thoughts here today. We're going to go ahead and do a couple quick announcements, and then I'm going to give people a chance to connect with you. So just bear with me 1 second here. This is our recent deal we closed. I know each of you could probably get up here and you could post something that you closed recently. This is a recent one that we closed in Jacksonville. So we're doing deals. I know each of you are doing deals. So if you are an investor and you're interested in reaching out, you can reach out to me, reach out to Bruce, Vikram, and Robert, because we're all doing deals. And if you're on one and on somebody else's, feel free to reach out. Also, like I mentioned, these events, we're doing an event next month on the 17th with David Morgan. You can't see his name, but it's Mark Moss. And then we've got somebody else, like our mystery person. Looks like Dr. Evil there with a shaved head. But anyway, so it's actually going to be a really great, it's going to be a great event. So I'm looking forward to be able to announce who that last person is as well. We actually just did an event on inflation. Our mystery person was a guy named Rick Rule, who that was a really great event. He, if anybody's in the metal space, he's a pretty well-known guy. So I'm going to put the link in the box for that event coming up. So if you'd like to sign up for that, feel free to do that. And why don't we go around starting with Robert and just say, what's a good way people can get in touch with you if they'd like to reach out?
Sure. Well, I'll keep it simple. Just hit me up at the email, the good old-fashioned 1990s email, Robert@REM Capital. Keep it simple.
Okay, awesome. Vikram.
You can. I'm on LinkedIn quite a bit, so you can just type in linkwithvic.com, and you can DM me there directly. So it's linkwithvik.com.
Linkwithvic.com. Okay, I'm putting in the chat here so people can do so. Linkwithvic.com. All right, Bruce.
Yeah, Elkhorn Capital Partners. I would just go to our website, elkhornpartners.com. There's a request info tab. Click that. Like I said, I just recently wrote a piece on inflation. It's basically working title is like on the Titanic, the band plays on. So happy to send that to you if you connect with us. I think you'll find it insightful. It's a lot more information than kind of what you'll find on Twitter or somewhere like that. So we're happy to share that with you. And we are working on some deals right now. We've got, like I said, we have 3 deals under contract. We're putting that, or 3 properties under contract. We put that all in one deal. One of them is a foreclosure, and we're expecting 19+% cash on cash on that. So reach out to us, and we can at least get to know each other in advance and see if it makes sense to work together at some point.
Awesome. Well, gentlemen, I want to thank you each for coming. Each of you have a really awesome approach to multifamily and great experience and great insights. I just want to really thank you and honor each of you for the contribution you made here tonight, as well as the contribution you're making in the world by getting people out of Wall Street and into Main Street. So well done, and hopefully we'll have you all back on a future panel. But thank you again for joining. Thank you to our audience for participating and for the questions and for engaging with us as well. So we'll look forward to hopefully seeing you guys on an upcoming panel, and hope everybody has a wonderful night.
Thanks, Bronson. Appreciate it.
Thank
you,
guys.
Bronson.
Thanks, everyone. Thanks, Vikram, Robert.